Good morning, everybody. Hope we're doing really good today. Welcome back to the channel. Back in August, I sold a few puts, and one of the puts I sold was on Kroger, the grocery store company, and that put got assigned, and ever since then I've been selling covered calls on it, and now my covered calls have finally got called away, and they even got called away for lower than my original strike price. My original strike price was $35, but I eventually had to sell covered calls for $33 for a $200 loss on the difference between the price I got assigned and the price I got called away at. So we're going to take a look at this little operation that took me 5 months to pull this operation off. And now we're going to go ahead and look at the numbers, see how I did. One thing that people like to say when talking about doing the wheel strategy is never sell a covered call with a strike price lower than the price that you were assigned at. But I think that just sometimes is impossible, and you don't know how long that company is going to be trading lower. So it's better to start selling covered calls and reduce your cost basis than wait for a rebound that may never come, or it could take years for you to get back up to that the price you were assigned at. All right, let's go ahead and jump in here and look at my numbers, okay? So I sold the original put on August 19th for $35, and it was expired for September 21st. So it looks like, well, not like that exactly. How about right there? Right there looks good. Now this first put, it got me $140.96 when I sold it. Then it got assigned, and you can see it had a big dip there. So to get any money out of this, I had to drop my strike price to $34. Sold a covered call for about $34 for $152.96. Expiring October 13th, right about there. Bought to close for $161.03. And this was before the election, so volatility was picking up. So I bought to close at for $161.03. Took a little bit of a loss, but I could roll it out for another month and make $318, right about there. So then in November, I actually bought to close this and sold another one that expired in December. This covered call I sold for $181.96, and it cost me $60.02 to buy to close this November contract. But on December 1st, we got a dividend because we were selling the covered calls. Got a $36 dividend there. And on December 11th, where's December 11th at? We went ahead and bought to close that, and we had to drop our strike price down to $33 and expiring that in January. Now, I bought to close this for $6.03, and because there was this big dip and this covered call wasn't worth any money anymore, so I rolled it and I sold this for $74.96, expiring in January. Now this contract is the one that got called away from me for $33. And actually that is not correct. Actually, I closed this one out, and I bought to close this for $14.03, and I sold the February for 94.96. So what is this? So this would be another $33 strike price. And yeah, so I got $94.96 out of that. And then, yeah, on January 22nd, yeah, right about there is when it got called away from me. Oh, and one more thing, since I was holding this, on, where it'd be March 1st, I got another dividend of 36 bucks. So we add it all up, I made 104 bucks in premium, then 152.96, sold, or I bought to close for 161.03, sold for 318.96, bought to close for 60.02, sold 181.96, got a $36 dividend, bought to close for 603, sold for 74.96, bought to close 1403, sold 94.96. Then if we take the $200 difference between the price that I got assigned at and the price the shares got called away at, I walk away from $395.65. So even though I took that $200 difference between assigned and getting called away, I still walked away with $395.65 in profit. Got paid out 2 dividends out of this deal, and altogether that's annualized. It's an 11% return, and Kroger hasn't really been doing anything great price-wise, but I still got a decent return out of it on an annual basis, 11%. So really happy about that. Took me a long time of continuing to sell covered calls, and even though I had to drop my strike price twice, it worked out in the end. Now, people like to say that never to sell a covered call strike price below the price you were assigned at, but sometimes that's not really possible, and you just you don't know how long it's going to be, trending downwards, or if it'll get back up to that price. But my thought process is we'll sell the covered calls and reduce our cost basis for when these things do get called away. We'll make as much money as we can or reduce our loss, and then we can get our money back in the game and, move on to better option plays and better stocks to sell the wheel strategy on. So I hope you get something out of this video, learn a little bit about how covered calls reduce cost basis. Like the video if you're still watching, subscribe to the channel if you haven't, and then I want you to go have a good day, alright? Justin out.